Hi, today we are looking at BFT Spac, which stands for Foley Transamine Acquisition Corp. 2, which is merging with PAYSAFE Stock. The ticker for PAYSAFE Stock will be PSFE. So BFT Spac is a $1.5 billion SPAC that is bringing PAYSAFE Stock public. BFT Spac has gone up about 40% in just the last few days. I'm wondering, is there more upside? Bill Foley is an industry titan, having created billions of dollars across several deals for shareholders along the way. And in one scenario, I'm penciling out BFT stock, or the BFT SPAC, ultimately the PaySafe stock, could have 140% upside over time. So we'll get into that a little bit later on in terms of valuation. But this video goes out to Adwin, Harpinder, and Prashant, who are all Unrivaled Investing Journey subscribers, as well as this video goes out to all Unrivaled Investing Journey subscribers. And on that note, a quick 10-second plug. If you enjoy learning about potential an introduction. I'm Daniel. You're watching Unrivaled Investing. This is a no-hype financial channel, mission focused on finding you exceptional companies and unrivaled investments. If you enjoy trying to find potential multi-baggers or learning about them, make sure you subscribe. If you're already a subscriber, I appreciate that thumbs up. And if you want to follow my personal journey to try to find potential multi-baggers, go to unrivaledinvesting.com, click on Journey. Now let's dig in. So first of all, what type of deal is it? Generally, I've seen a couple of different types of SPACs. I've seen the super fast growth SPAC, where a company clearly has product market fit. They may not have scale, they may not be profitable yet, but they have product market fit. So I am interested. I'm thinking about, does this have 10x potential? Are they unrivaled? What did the long-term economics look like? Those are the types of SPACs that get me the most interested because there's steak to the sizzle. I'd say the next down is a company with a promising idea. Those I'm inherently not as interested in because I'm not sure if ultimately you have product market fit. Like maybe you have a business model where you have dramatically negative gross margins. So you haven't really proven to yourself that you can charge what you need to do just to be economically sustainable, have a positive gross margin. And if you have a promising idea, maybe you don't even really have material revenue, it's hard for me really to get conviction like, hey, this is going to be an idea that's worth putting 10% of my portfolio into it. So that's why it's a far second down. And then even further below that, I would say, is financial engineering, where it's just about private equity firms sort of passing one deal to the next, trying to get a higher and higher valuation, sort of trying to take advantage of the public market. You get honestly, a lot of these private equity folks think the Robin Hood types, think the everyday traders are a bunch of idiots that don't know how to price things. And they're trying to take advantage of that with these types of private equity deals. And I actually called one out where I was like, look, I don't like this. Smells like financial engineering. And that was Multiplan. I called that video out. You can see it right over here. I did a video on it before it was Multiplan, when it was CCXX. That was the SPAC. Now it's MPLN. When I did the video, it was up a lot more than it is now. So since I did that video where I passed on it, I was like, look, this is financial engineering. I don't love the company, don't love, effectively hot potato between one private equity firm to another. They're down about 20-30% in an up market. So I'm glad that we passed on that. You can check out that video yourself if you're interested. But when I'm looking at these SPACs, I'm always wondering, like, what type of deal are we looking at? Are we looking at, this sort of fast growth company? Because if you're talking about a fast growth company, then if it's a SPAC or it's trading for a few months, I can justify it going up like 45% in a few months if you're growing 90%, because then it's like, oh yeah, fundamentals justify it. The valuation actually stayed the same over that time period. Valuation could stay perfectly flat if you're growing 90% and the stock price goes up. Along with that growth, it makes sense because it's a business where it has that underlying fundamental growth. And as a matter of fact, Journey subscribers know that one of my most recent multi-bagger calls was a company that's a SPAC that I trimmed out of significantly. It was up, over 40% in a couple of months, and it's because of this sort of very fast, 90% plus revenue growth dynamic. So I as an investor, I get more excited by these first two. The super fast growth with product market fit, because that sort of strikes me as, do you have 10x potential? And a promising idea that can get animal spirits going, like, oh my gosh, think about this market that they're tapping into. The last one, financial engineering, that's a lot trickier. You're talking about, hey, let's squeeze our interest rates a little bit on the debt that or maybe we borrow more money and we can juice our returns that way, or maybe we could do squeeze this business somehow. And it's financial engineering versus true organic growth, and that's really what gets me excited. But let's actually dig in, like ask ourselves, what type of deal is this? What type of deal is BFT? And it is it's really financial engineering. It's that last piece where, look, they're talking about how they're doing this deal. 1.5 billion is coming in. You got a $2 billion private placement. 1.1 is to pay down existing debt, which brings their debt level to 3.6 times EBITDA. The EBITDA is actually going to be even higher because this is 2021 EBITDA, which assumes their EBITDA grows nicely between 2020 and 2021. Their EBITDA level would actually be closer to like 4 or 5 times based on current results. And so it's about paying down debt, and this is a lot of debt, keep in mind, and cash consideration to pay existing shareholders, i.e. the private equity investors. They're getting a payday. Make it rain for Blackstone and CVC. And then this deal's all about, it's not about, hey, there's this huge 10x opportunity that we're tapping into. No, it's about, hey, what are the things that we can sort of transform the company, squeeze margins, squeeze profitability, and oh yeah, there's this US iGaming expansion. That's 15 million of the total here that they're, of this total pie here. It's relatively small if you look at it right here of the contribution, but it's this deal is about financial engineering. Don't make any mistake about it. And there's a key part of this chart that you're going to want to take a good look at, because we'll get at in a second. But overall, the deal is struck around $7 billion. You need to factor in nearly $2 billion in debt on the balance sheet. They don't show the gross debt, which is kind of annoying because it makes it easier for you to factor what your interest expense is going to be. But all in, you factor these two things and you're looking at a $9 billion enterprise value. And this is, but I should take a step back. Not all financial engineering is bad. William P. Foley or Bill Foley, he is a titan. Like, if you see the deals he's done, he's just created immense value over time. For example, he's the founder, former CEO, and now chairman of Fidelity National Financial, which he has built into the largest title insurance company, growing the equity in the company from $3 million at its LBO in 1984 to $11 billion recently. So, like, immense value creation. And he's done it over and over again with FIS, Black Knight, Ceridian, Dun & Bradstreet, just creating multi-baggers over and over again. So this is a really interesting sign. Like, he's been able to create immense wealth over time. And a lot of it, like, he's targeting experts in cost synergy realization. This is not, let's tap into this huge, multi-bagger market. This is like, hey, how do we squeeze the costs out of a deal? Synergy bonus pool to align incentive and drive performance. This is about, like, hey, how do I make sure all my employees are rowing in the right direction? It's about M&A transaction, bringing his prowess with M&A. Oh, look at all these. Here's all the historical forecasted savings, and then here's the savings that they were able to achieve. The companies I like to look at generally are like, hey, we're focused on how do we grow the top line at a good clip, or what's the opportunity that can lead us to double, triple, quadruple in size over the next few years. So that's, it is a little bit of a different approach here. It's how do we optimize our profits, and like, hey, we penciled out 150 million in savings and we got actually 312. So, like, wow, we're a baller. Or we penciled out 260 and we got 300. But you really need to understand, he's a baller. He's a titan. He's created immense value over time. And PaySafe is really a story about Bill Foley. Can this 75-year-old titan, the chair of BFT, help drive great returns for future shareholders? And let's actually go back to this prior page. He's an investor in this SPAC, and this is what the SPAC shareholders are going to get. But as completion is part of the deal, he is going to get this 4% as well. And so the economics of this deal are a little different for him, just because that, look, 4% on, let's say, $8 billion, $7 billion deal, that's an extra 300 million in his pocket. So I would say his risk reward is about 300 million differences than what you and I have. That said, look, he does have a lot of a lot of reputational aspect that he can bring to the deal, and that's the reason why he's able to get a couple percent just for completing the deal. That's 4% that goes to him effectively. And in case it's not obvious, as I've said already, it's largely about Bill Foley because, look, these guys are just hired guns. This CEO, Philip McHugh, he joined PaySafe in 2019 as CEO, i.e., this guy has no, history with PaySafe, no background experience with PaySafe. He's a hired gun. Oh, Izzy Dawood? Izzy joined PaySafe? Oh, just a few months ago in 2020 as CFO. So these guys are these missionaries that have a missionary zeal to bring PaySafe to the next level, or are they mercenaries that it's like Bill Foley's going to tell them what to do, you need to do this, and boom, make it happen. It strikes me as very obvious what type of setup this is. And in case I didn't mention already, this deal is all about Bill Foley because it's kind of obvious where they say Bill Foley is an agent of change and transformation. Foley track record of synergy achievement. Foley team drives revenue growth. Foley track record of success in highly regulated industries. Foley governance team with expertise in transformation, M&A. So it sort of cracks me up just because here it is. It's this bet that leans so heavily on the 75-year-old Titan. So what is the BFT Spac? What is PaySafe business? And you've got a couple of different pieces here. We'll go in order of size. You got PaySafe Integrated Processing, which helps the processing for 250,000 merchants. That represents about 50% of their revenue. It has 57% margins. That's a very healthy margin, very, very nice piece of the business where they take about a 1% cut on $75 billion in business that goes. So $75 billion in processing for these 250,000 merchants, and that 1% cut translates into about 264 million in revenue. That's how you should read this. And about 50% of this business is tied to e-commerce. Then there's eCash, and we'll go into the details behind eCash and digital wallets in a minute or two. eCash is actually their third largest business, so not the second, the third, where it has about $5 billion in processing, but it has this huge take rate of 7%. So 7 cents of every dollar that goes in goes to them as revenue. So you'll want to understand why that is. Once again, a very nice high margin business. And then their highest margin business is this digital wallets, 82% margins. That is just ridiculously rich, where they have a 2% take rate nearly, which is, effectively double this processing amount. So I'd be very interested in learning more about this digital wallets. Can this grow relative to these other segments? 3.8 million active users using their digital wallets. That's, this means this business does have scale. And, the reality is you can't have a business with multi-billion dollars of debt without scale, without significant EBITDA, because at the end of the day, you wouldn't have bankers willing to lend to them unless you have, significant EBITDA. And generally private equity folks wouldn't, lever up a deal unless they have, some sort of consistency. And when you have 12 million active users using eCash, 3.8 million active users using their digital wallets, 250,000 merchants using them for processing, like credit card processing, spread across over $100 billion of volume, like you're thinking this business should be stable over time. Maybe it grows a bit over time. So this is their PaySafe Integrated Processing, their processing segment. That's their largest segment, about 50% of their revenue. Next largest is their digital wallets, which is 30%, but more than that on a margin perspective. And then PaySafe eCash, which is about 21% of their revenue. So let's go through their processing segment. So this segment is all about acquiring merchants that need to use credit cards. So, i.e., allowing merchants to do credit card business, whether or not it's on e-commerce or small, medium businesses. And they're the number 4 independent merchant acquirer in the United States. I actually think this is a really misleading, way to show it, because the reality is there are so many, independent excludes all the large banks that are acquiring merchants to use the credit cards. To have a processing, a point of sale processing unit. But anywho, so they're number 4. Either way, when I see number 4, I'm automatically thinking, okay, you're in a competitive market. This is not going to be an unrivaled investment, which is a key filter that I look at with all prospective investments. That said, they do have 250,000 merchants, and they're expecting about 10%, annualized growth over the next few years. What's interesting is that they talk about how they're a Clover Smart point of sale reseller, which is sort of like, what? They use Clover for their merchants? And yeah, their Clover is actually owned by one of their competitors, which is Fiserv or Fiserv. And they're one of the official resellers of Clover technology. So now I'm like, okay, this segment is definitely not unrivaled. You're a reseller of a competitor's product. There's a bunch of official Clover partners that are selling the Clover point of sale system. And keep in mind, this point of sale system is very similar to the Square dongle that you see. It's enabling small, medium businesses to do commerce. But, look, this is beyond just that. They also have e-commerce related things. But on this segment, which is about 50% of their revenue, I'm not super excited seeing some of these things. So I want to start learning about their other segments. Is there a lot of potential here that maybe is not obvious at first? So what about the other segments? And so first is looking at the digital wallet, where they have a couple of different apps like Skrill and Neteller. And it's about a diversified network of digital wallet solutions. We'll get into what that means. It's spread across 120 different markets, so this is a global player. Elsewhere in the presentation, they claim to be the number 2 digital wallet, excluding major credential wallets like Apple or Samsung Wallet, as well as closed loop wallets like individual retailers. Overall, it's not super convincing when you have to use all these caveats like, oh yeah, we're number 4 if you exclude all these big guys. But still, this is interesting to me because I see that they're actually penciling out an above average, revenue growth rate. 14% means you really think there's an opportunity you're targeting here. And whenever you have a private equity setup that's using debt and potentially grow at even a teens plus, starts getting, interesting. 3.8 million users. So what exactly is this? Like, what are they enabling? I see this iGaming, remittance, trading, prepaid, and it says it enables consumers to upload, store, withdraw, and pay funds from a virtual account using these different apps. That's about 30% of their revenue. So what sort of needs does the digital wallet address? And so what's interesting here, this shows you what they do. What's the digital wallet do for their merchants, the merchants that have enabled the digital wallet? So here, like a customer, this is a hypothetical customer, but they're showing like the types of issues that a customer will have. Well, saying like, I'm able to upload and withdraw funds with ease. I enjoy sports betting and online poker at my favorite brands. I love to trade crypto and move money into multiple currencies. So like just from this alone, I'm like, okay, this is to enable or to make it easier to transact with gambling and crypto. That's like a big component of that when I see this. So you're effectively making a bet on the ease. Will there be increasing demand for crypto where people are going to want to be able to move, let's say, cash from their bank account to a digital wallet? And you can see the merchants that have enabled them. I mean, Coinbase, that's a major, crypto company. You can see Betfair, Bet365, DraftKings, Golden Nugget, PokerStars, Sports Betting. These are all merchants that are customers of PaySafe. So this is getting me interesting. Getting me interested. Like, oh, okay, you definitely have some really interesting clients here that are enabling online gambling, online sports betting. Okay, so what's the iGaming market look like? Like, are they tapping into an opportunity that could be like really revolutionary for the stock? And here they show like, look, we have, first of all, based on their current take rate of around 2%, if they captured half of the upside that they're penciling here. So right now they're saying like the iGaming market's around 3.4 billion. Longer term, let's say over the next 5 years, They think this thing's just going to go parabolic, growing at 50% a year to 47 billion. If they capture half of this upside, now this is processing that's going through their platform, and they have around a 2% take rate, that implies upside of about 436 million in revenue, incremental revenue, or about 30% revenue expansion. Now, because this is much higher margin segment, this is an 80% margin segment, this digital wallet, then I would think it would have a much higher operating profit contribution. So maybe profits double with having this. Like maybe this does support some sort of EBITDA thesis that you're able to grow underlying operating profits by a teens rate just organically over time. And you can see how they sort of lay out how they compare on a business to business and business to consumer perspective. And they're saying, look, we're the best relative to all these other players. The concern I have here is if you look at some of the others like Nuvi, that's a relatively new or public company. They're growing at like 60% a year. So when I see that, it does make me a little bit concerned. Like that growth rate relative to PaySafe makes me wonder if PaySafe's value proposition is at risk. Because when you see a competitor growing much faster than you, it makes me wonder, are they taking share from them? But you can see 60 plus US iGaming customers, DraftKings, lottery in North Dakota, the Virginia lottery, it looks like, Michigan lottery. So all things that they're enabling people to gamble more. And they're effectively saying, look, they think that can be a huge trend in the years ahead. I really don't like it calling iGaming. When I'm thinking of gaming, I'm thinking of like playing Fortnite or a shoot 'em up or something like that. Whereas when I see this, it's like, oh, this is gambling, right? But anyways, that's how they're describing it. Clearly a lot of potential though, from this. What else? So next up is their eCash segment. So this is their third segment, their smallest segment, where it enables consumers to use cash to pay for goods and services online through both a prepaid and barcode payment, billing, invoice, etc. solution. So this is once again for gambling, video gaming, utilities, social media, financial services, rent payments. Now here, what's interesting, this is the lowest growth segment that they're targeting. So only 8% growth versus 10% for processing and 14% for their digital wallet. Their take rate is the highest of their segments. This is 7% take rate versus 2% for digital wallet and 1% for processing. I would say when you see take rates, that's probably a good indication of how you fare on a competitive perspective, because the less competition, the more you can charge on a per dollar basis, for the services you're offering. That said, you can't push it too far because, once you push it beyond a certain level, then your end customers, reject it somehow or they find alternatives. So I'd say you can only push that so far. But this is something about enabling 12 million active users. They're redeemable. So this is like prepaid cards that you can convert, redeemable at 2,800 online stores. So prepaid cards that are redeemable in 2,800 online stores, $4.7 billion in volume or dollars that they're expecting to go through these prepaid cards, which would translate into 318 million in revenue, 50 markets. So this is a global company once again, 650,000 distribution points. So that's a lot of different places where you can top up your card for something like video gaming. And the point I was saying earlier about the higher take rate, I would suspect the read-through on this is that longer term, I would suspect fewer and fewer people are looking for prepaid cards as a solution. They're sort of saying, look, these prepaid cards are helpful, for example, for the underbanked. And I wonder how long that really is a viable market, especially when you see things like Square Cash App. But I'll talk about that in a second. So what needs does this business solve or address? And you can see like serving Gen Z, millennial, and underbanked consumers across 50 plus markets. If I pre-buy cash vouchers to upload for online gaming upgrades, I buy online, but I pay in cash at my local convenience store. So people are just, PaySafe card is everywhere. I'm never far from topping it off. If I'm not playing, I'm streaming. I can pay cash for my whole online life. The whole idea is that you can go to one of these distribution points, a CVS pharmacy, a Shell station, a Dollar General, top up a card, and then when you go home, you can use that card or use a barcode that you scanned, and then you have cash that you can play in Fortnite, Amazon, Twitch, and that that might be helpful for a younger kid that maybe doesn't have a bank account, and the kid's like, "Hey Ma, where's the meatloaf?" Or like, "Hey Ma, like, can I top off my Roblox card?" And they're like, "Yeah, just do whatever you gotta do. Like, here's my credit card. Go take it to Dollar General or something. Go top it off." So like that's sort of what I think is going on here. It's kind of like that Will Ferrell scene. "Hey Ma, where's the meatloaf?" So you get some kids that are looking to top off their cards. That way they can Twitch a little longer or play some Fortnite. I wonder if the underbanked aspect is going to decline over time because it's becoming so much easier to get a bank account, like with Square, the Cash App. So what makes all these different pieces so special? Because the reality is, when you're looking at these different things, they all sort of fit together in a pie. And this is the part that gets it interesting. By offering a full suite of solutions, they're not just a reseller of Clover solutions or Clover products, but there's a lot more here. So yes, there's this reseller aspect for merchants, for 250,000 merchants, where they're enabling them to have an e-commerce presence. They're enabling small and medium businesses to do businesses, to take credit cards, for example. But they're also enabling companies to have digital wallets, to have eCash, and that starts becoming a valuable network, because we're like, oh yeah, we can enable all credit card processing that goes through your website. In addition to that, we also offer these cool things like digital wallets, like eCash, and because of this, by having this full suite of solutions, they say, look, if you look at our competitors, our peers on average charge about 0.8% of the dollar processing that goes through. So for every $1 that goes through, they don't get 1 cent, they get 0.8 cents, whereas they're getting 1.4 cents for every deal. So that's a big difference, and I think it's largely attributable to the fact that digital wallet and eCash are much higher take rates, much higher margin products, or much higher take rates. Certainly, digital wallet is a much higher margin than this sort of straightforward commoditized processing business, where you're competing with a lot of other players ultimately. So what does this sort of lead to? Like, yeah, they're starting to make a move in iGaming, but you know what? They could potentially tackle a bunch of other verticals as well, like education or subscription, health and wellness, rental or petrol, field services, social media, travel, property management. So they think there's a lot of different verticals here that they could be tapping into beyond just gambling. And once you prove yourself out with one vertical, like, hey, we're dominating gambling and we have all the top sites, maybe they can start moving into, let's say, property management or rentals, where it makes it easier for people to pay for their rentals or things like that. And you can see the types of customers that they're calling out, like, hey, these are potential customers or customers that we currently have, that fit into these verticals. Okay, so what about their financials? We've gone over, their business model. What about their financials? And what's interesting here as we look about their financials is that their revenue's actually forecasted to decline slightly this year, which cracks me up relative to the price action, where this thing just gets jacked up, 40% in a few days. Like, this is not one of these, super, this company's just going to grow crazy fast, and like, wait a second, they're posting up a negative number this year. Like, everyone, like, calm down, put your clothes back on. Like, this is not like crazy sexy when you see their financials. Like their processing segment, you can't see it here, but it dipped significantly in April. That was down about 20%. Right now, as of October, it's sort of flat, maybe down just a couple percent. Their digital wallet segment, that's down like over 10%, relative to where it was, at the start of the year. And so a lot of that is like sports betting, where there just were a lot fewer games, so a lot fewer play. So that makes sense why that, you sort of had that hit. But eCash, like all those kids wanting meatloaf and to play Roblox, that eCash is up significantly, like 30% from the start of the year. And that also is one of their higher take rate segments. So to have a bigger, jump in revenue, it does sort of help their business. So overall, their take rate's up significantly from 2019. This is what they're forecasting, but revenue is effectively flat, down marginally year over year. And so that's sort of what you're seeing, in each of these different segments, from processing to the digital wallet to eCash. Now, what about their growth prospects? Because I recognize this is a very unusual year that we're looking at here. And, they're targeting 70% EBITDA growth over the next 3 years. EBITDA is a proxy for free cash flow, where you can see, they did about 470 in free cash flow in 2019. They're actually forecasting a material drop in 2020. So it cracks me up once again that when they're calculating their debt leverage ratio, they're like, yes, we're calculating it based on 2021, where they're expecting their EBITDA to presumably be at a record level of 560 or 500 million, which is way above 2019, which makes me wonder if part of the reason why they're doing this deal is because they had some sort of debt covenant that they breached. That is just a question. I would wonder if they post something like that in the filing. I didn't see anything like that, but one could argue that this drop, because it was unexpected, might have caused them to trigger a debt covenant. I haven't seen their debt or their debt terms, but that would completely change the perspective of this deal. But anywho, Bill Foley's excited to get into it. But this is interesting. They show like very, very granular detail. And this gets back into the financial engineering that you can smell, where they want to pencil out to the each million, like where does each million of squeezing this lemon, where do they get it? Now, this company's not a lemon. I don't want to say that, but where do you squeeze each drop of juice out of this company? And like they have this table here in their presentation where like they can pencil out 5 million and 6 million from these various different subjects, like fraud reduction, failed deposits of digital wallets, cross-selling funnel. Oh, we think we can get 25 million here. And so they're like targeting very clearly, like, oh, 5 million here, 5 million there. Like let's build this up into this some sort of model and how we squeeze this out. This is like, look, if you're going to do financial engineering, you might as well do it right like this. It's hyper detailed on how do you squeeze out each dollar, and that's probably how you need to do it in order to build it up. This is a Bill Foley special over here. The reality is, though, growing from 470 million in EBITDA to potentially 744 million, 70% growth over this time period, is pretty interesting. Is pretty attractive, if they're able to deliver that. If Bill Foley, likes to, do even better than what he articulates, then I think that would be, very solid returns for prospective investors, depending on what valuations look like. And we'll get into that in a second. So that's what this is, what we're talking about with valuation. You'll notice this sheet is a little different than what you usually see, where I'm usually working top down and then sort of building it up like, hey, this is the revenue and what's sort of an optimized margin. Here I'm working with what's the EBITDA, what's the implied free cash flow, and what's the, let's do a range of potential free cash flow yields and how you'd think about this business. Because ultimately, this is actually sort of what drives a lot of investing, which is free cash flow yield. Yields relative to everything else. That is the heart and soul of investing. What is the yield that you're getting this relative to everything else? And my value proposition to you, the loyal YouTube subscriber, loyal YouTube viewer, is that I provide this sheet below in the description for you to click on. You can download it and play around with your own assumptions, however you'd like. So, how's this sheet work? So right now it's $14 a share. I didn't see a share count in their presentation. So they show, based on the deal, that it's around $7 billion, equity value implied. Using a $10 share price, which is what the deal, was struck at, that implies around 720 million shares. So based on that and the current $14 share price for BFT Spac, that implies they're valuing PaySafe around $10 billion market cap. Keep in mind, this is before the $2 billion in debt. We'll get into the implications of the debt in a second. So their guidance is about 500 to 560 million in EBITDA in 2021. I'm giving a broader range to 575, saying, hey, their digital wallet, sports gambling really starts picking up. They do even better than expected. Let's do better than expected, because that's Bill Foley for you. But they do have a sizable interest expense. Here it is. I'm penciling out a range of 120 to 140. It might be higher. The reality is I'm not sure the exact amount of debt they have. I do know that they have I think around $1.8 billion in net debt. That's net of cash on the balance sheet. And so, assuming around 5.5% debt, cost of servicing that debt, not even paying amortization, just paying the interest payment on that is around this part. So this is ballpark figure. And then depreciation and amortization, this was based on looking at the 2019 financials. Keep in mind, don't worry about this. This is a non-cash expense that gets added back a little bit later, but it does impact what cash taxes you pay. So this results in, 500 minus 140 minus 280 gets you 80 million in pre-tax income, or 175 million in pre-tax income. Slap on some sort of tax expense. I'm not sure if this should be appropriate, because I've seen other articles indicating that they used to be a UK-based company. So, either way, it's not, magnitudes off, directionally it's right. So you can see net income of 60 to, let's say, 130 million in net income. Now let's make some adjustments to think about what the free cash flow is. So add back that depreciation and amortization expense, and this is approximately based on 2019's results, less CapEx. Once again, as an aside, I really didn't like the way the bankers laid out the presentation. I thought it was confusing as heck, and it could have been done a much cleaner way, breaking out some of these details. So I wonder if they were purposely trying to hide it. For example, they have this measure called cash conversion, like adjusted cash margin conversion, something like that. It's really a deceptive figure. It's like, dude, why don't you just call it EBITDA less CapEx and call it a day? So instead, they had this cash conversion at 80%, which is a way of saying EBITDA less CapEx, and they're saying it's 80%. And so that would imply about 20% is CapEx of their EBITDA. So I do that over here. This is an estimate based on this adjusted cash conversion of 80%. It's an estimate based on what they're provided. So you take this net income, you add back D&A, but you do subtract CapEx, and that gets you to what their free cash flow is of around 240 to, let's say, 300 million in free cash flow, which based on their current market cap really isn't that compelling. That is, 2 to 3% yield. So you're if this were a bond and there were no growth prospects, you'd be like, this is a pretty lousy deal. You got a company that's pretty levered, and if there's no growth prospects, all that I'm going to get is 3%. Oh. But that's where it's hey, but this is Bill Foley, and I bet he's going to get a lot of really interesting synergies, cut a lot of the costs. He might do some wicked, awesome, mergers and acquisitions where they find all sorts of interesting targets. And so maybe they could actually grow free cash flow at, let's say, 12.5 to, let's say, 22.5. This is a ballpark range that I'm putting out. Part of this, and this is a lot of more art than science, is look, they think their organic growth rate is 10% in processing, 14% in their high margin segment, and they think gaming is going to grow really fast, and they've got these major gaming customers. So when I see that, I'm like, okay, I can underwrite potentially that you have, double-digit growth in your free cash flow. You slap on the fact that maybe they do some, each year they're generating cash flow. What are they doing with it? If they keep the balance sheet levered at the same rate, maybe they use that cash flow to buy, new companies. And, Bill Foley thinks there's a lot of deals out there. We'll get into that in a second. So 12.5% to 22.5%. So this is the key driver of what your return is, because as I penciled out already, the free cash flow yield is really low. This means people are baking in a lot, and part of this is the 40% rise since the deal was done. I personally think Bill Foley paid the top dollar he was willing to pay for this deal. He was probably willing to pay more for this deal because it's a SPAC where he's getting 4% of the company effectively for free if the deal goes through. So that's 300 million buckaroos that sort of incentivize him to do the deal. If this deal were at a lower price, would he have done this deal if he wasn't getting that 4%? And that's a question for me that I'm asking. I suspect he was paying sort of that top dollar that he'd be willing to pay, given that he's getting that 4%. So doing a 40% premium on top of that sort of starts making me a little edgy, given that I think he probably already paid the top dollar that he's willing to do. Then, what sort of multiple are you assuming? One should consider look, this is an indebted company. Whenever you're looking at private equity deals that require tapping into sort of the kindness of strangers, in this case, it's the debt markets, to sort of say, hey, lenders, cut me a good deal. When you do that, and either it's requiring to refinance your debt, or you're looking to merge or acquire something else, maybe borrow more funds, the more leverage, the more volatility in that sort of multiple that the equity gets. Because in dark times, people get scared about, hey, can you pay off your debt? And when that happens, the equity really gets hit. And so this is why I'm assuming a lower than what I would normally assume for a business of the stability and caliber. Like this business is a very stable business. Like, let's be straight, it has very incredible margins. It's it's a robust business. I'm not saying it's unrivaled. I'm not saying it meets that test, but I'm saying it's a really strong business. I am assigning a slightly lower multiple on the low side, partly because it is an indebted business. And so that means, in indebted, Warren Buffett likes to describe debt as sort of driving around with a dagger on the steering wheel. You pray you don't hit a bump that's too big, because if you do, but that's why Buffett always is like, hey, that's why I keep $20 billion in cash sitting around. Not everyone's Warren Buffett, unfortunately. And on the high side, this sort of assumes, hey, very little sort of multiple change from here, and you're assuming, like, effectively people remain exuberant about the valuation. They assume they're going to be able to continue to compound in the years ahead, and let's apply sort of a frothy or very full yield to this. And the way to think about implied yield is it's the inverse of whatever the multiple is to their free cash flow. So 30 times. So the downside here is about 36%. The upside, I'm saying, is over 140%. So as I mentioned in the first few seconds of this video, I said in the high side, you could probably pencil out, a hypothetical where it goes up 140%. But look, this is my framework for how I think about things. Could this go higher or lower? Of course, it could go a lot higher, it could go a lot lower, but that's always animal spirits. You should be able to have a logical framework from which you think things. Animal spirits, that can always override an investment in the short term where people just go bananas. So overall, I like PaySafe. I think it's a very robust company. It's trying to set itself apart in the processing space, which is inherently very competitive, but they are doing clever things with that digital wallet and with eCash. The risk reward of this setup isn't bad, but a lot depends on the oversight of the 75-year-old titan, Bill Foley, overseeing these new hired guns that they've brought onto the company. It requires the debt markets to be functional. They are pretty fully levered. Could they be more levered? Absolutely, but that's more leverage that I like to have personally, and it requires the ability to execute on finding attractive mergers and acquisitions deals. And this upside really, in my opinion, requires executing not only on the costs, but finding multiple deals that they find to be compelling. So do they think there's a lot of deals out there? And yes, like they make that very clear. This is a target-rich environment where they think there are significant acquisition opportunities across all segments. Target-rich environment, by the way, is a phrase that I'm stealing from one of my favorite sci-fi series, Columbus Day, if you're ever interested in a good sci-fi series. Quick plug for, I'm not paid or anything for that, I just really enjoy them. So here, they say, look, there's lots of different opportunities in the digital wallet consolidation, over 300 specialized wallets, globally, which lack scale and have limited capabilities. So look, there's a lot of individual verticals that have very specific wallets. So, hey, we could acquire some of them, and then all of a sudden our wallet becomes that much more valuable because we can target very specific verticals. Maybe it's the rent vertical, maybe it's the education vertical. They're talking about e-commerce integration, more e-commerce integrations, more eCash, iGaming, tapping into, maybe there's other ways to get iGaming services like geo-compliance services, marketing, data. And once again, it's all about Foley's best-in-class execution and network to make these deals happen. Make this 75-year-old work harder. I suspect it's very, very probable that they lever up and do more deals in the future. And a lot of their future returns depend on their success in this arena of finding and executing on worthwhile deals. One thing I don't like about BFT Spac or PAYSAFE stock is that you're paying up. You're paying up a bit. And so you can see, like go back to 2017 when Blackstone and CVC, the current private equity firms that are owners in, PaySafe stock, they bought the entire company for around $3.9 billion. I believe that's the enterprise value, so that includes the debt that they layered on. In 2017, based on the data, limited data they provided, it implies around $864 million in sales, so about 4.5 times enterprise value to sales. In contrast, Bill Foley's deal implies about 6 times EV to sales, and the current valuation is closer to 8 times, this $14 price. So the current valuation is nearly 90% above what these private equity investors were willing to pay, just a few years ago. So, and that's the change in valuation. That's not a change in fundamentals. That's a change in how much people are willing to pay per dollar of fundamentals. So yeah, it bothers me. They go on, it's what was the thesis back in 2017? Well, drive demand for secure online payment services, support the company's growth both organically and through acquisitions. Wow, that sounds familiar. A big part of PaySafe's business is its digital wallet technology. Sounds familiar, which allow users to make bets online without tapping money from their bank accounts. So like the same thesis 2 years ago at half the price. Now maybe you could argue like, hey, 2017 they got a better deal. I just don't like paying up. And we're in an environment where everyone's sort of paying up for things, and it's made extra uncomfortable for me because of the fact that Bill Foley's getting 4%, part of this deal just if the deal executes. And so his risk reward is going to be different than mine. If I were to buy the shares now or even buy at $10, his risk reward is different than mine. So will PaySafe be part of my journey? And to know that answer, well, actually, probably not. Not at this price, but maybe in the future. That's sort of like my quick takeaway. Like honestly, I'd prefer a company with an unrivaled value proposition and clear, 10x potential or something like that. But if you do want to see if ultimately I change my mind about it and maybe I buy it in the future, or maybe the valuation comes down, maybe it goes back to $10 a share and I revisit, or maybe they make it, a changing acquisition, a transformative acquisition, in that situation, maybe I would revisit it. But if you want to see what I am holding in any given month, you go to unrivaledinvesting.com, click on Journey, and the reality is there's a lot of different types of exclusive content there. Some of it's exclusive content on individual companies. Sometimes it's an educational series. My goal with Unrivaled Investing Journey is to post at least, aim for at least one time per month up, finding a potential multi-bagger, that I'm calling out not only for myself, because hopefully I'm buying it for myself, but also for Journey subscribers. And I actually just did my December post on a potential multi-bagger that I own, already in my portfolio. I just posted that exclusive video for Journey subscribers, and you can see the catalog of content below, in the description, so you can see all the different videos and sources or data, things that I've posted. You can click on it if you're interested in learning more about what Unrivaled Investing Journey is all about. It's really, it comes down to just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these types of multi-baggers, go to unrivaledinvesting.com and you can see, like what do I hold in any given month? What do I buy, sell? All that sort of stuff. What are the shares you just can't take away from me? And at the end of the day, if you enjoyed this video about BFT Spac or PaySafe, please make sure you subscribe. If you're already a subscriber, I appreciate that thumbs up, and thank you so much for watching.